Welcome to the Deep Dive. Today we're looking at MoneyHero Ltd, that's MNY, and their Q2 2025 earnings. And if you follow this U.S.-listed company operating out in Southeast Asia, you probably saw what happened. It was a really fascinating, maybe confusing moment.
Definitely. Management came out with this story, a really clear narrative, actually, about building structural profitability. The results seem to back it up, too.
But the market, a totally different reaction. The stock dropped, 18%? A pretty harsh vote of no confidence, wouldn't you say?
Absolutely. It felt like a textbook case, really. Short-term worries about, transaction speed just completely overshadowing the long-term structural improvements.
Right. Management kept saying they're reshaping MoneyHero for durable, profitable growth. That was the phrase, wasn't it? Quality over quantity.
Exactly. And the numbers, if you look closely, they show they did it. They executed that pivot. But yeah, the market just saw that top-line number and panic.
Oh, okay, so let's unpack that. This tale of two quarters, as you might call it. Let's start with the headline figures, the ones that clearly spooked investors.
Okay.
Revenue came in at $18.0 million. Now, consensus was looking for something closer to $20.0 million.
Right.
So that's a miss. And it's also a 13% drop compared to the same quarter last year. That decline, that deceleration, that's the red flag, isn't it?
That's definitely what the market reacted to. But, you have to look beneath that headline because the profitability story is, it's completely different. Immense swing.
Okay, how so?
Well, GAAP EPS landed right at $0. Consensus was expecting a loss, -2 cents. So that's a beat. And basic EPS was actually positive $0.01.
Positive EPS, okay.
And here's the really big one. Net income. It flipped positive, $0.2 million in the black. Now compare that to last year. A $12.2 million loss.
Wow, okay, that is a massive turnaround. From a $12 million loss to slightly positive net income, that's profound.
It really is.
Yeah.
And it's not just a GAAP accounting trick either. Look at Adjusted EBITDA. The loss there narrowed hugely, down to just negative $2.0 million. That's a 79% improvement year over year.
79%. Okay, so the picture forming here is they deliberately pumped the brakes on maybe less profitable revenue to focus squarely on unit economics, on margin. And they actually delivered on that margin improvement.
Exactly. They delivered the hard part. What's really interesting is how deliberate it was. This wasn't just trimming around the edges. They performed like structural surgery on the gross margin.
How drastic are we talking?
Cost of revenue, it dropped materially. It's now just 51% of revenue.
Wait, 51%? What was it before?
That's a 16 percentage point improvement compared to last year. 16 points.
Okay, hold on. 16 points on gross margin.
Yeah.
For a business like this, a comparison platform, that's not just optimization, that's like a whole new engine, isn't it? It totally changes their CAC sensitivity.
It fundamentally does. They need much less volume now to justify the spending to acquire a customer. That margin expansion is the engine driving that huge profitability swing we just talked about.
And how did they pull that off? 16 points is huge.
Management pointed to their reward intelligence playbooks. Basically, that means using data, probably AI too, to get really smart about customer rewards.
So not overspending on rewards for customers who might just grab the offer and disappear, getting better quality traffic.
Precisely. Better calibration, higher quality applicants, people who actually convert and stick around. It's about discipline.
And you see that discipline elsewhere too, right? Like in the revenue mix itself.
Absolutely. They've been strategically pushing the higher margin stuff, insurance and wealth management.
Right.
Those categories now make up 27% of total revenue. That's up 5 percentage points from last year.
So that top line miss we started with, it wasn't just an accident. It was partly the result of them intentionally pulling back on lower margin products, like maybe some credit card offers.
Exactly. They moderated the lower margin volume deliberately to focus on these higher value verticals.
And this discipline, it went deeper than just gross margin, didn't it? What about operating expenses?
Oh yeah. OpEx, if you exclude the FX noise, fell 37% year over year, down to $20.6 million.
37% cut in OpEx. Wow. Where did those cuts come from?
They were specific. Technology costs down 58%. Employee benefits down 45%. These are deep cuts.
Okay, I see the discipline, the margin expansion is undeniable, textbook execution on that front.
Yeah.
But cuts that deep. Tech down almost 60%, employee benefits nearly halved. Doesn't that risk crippling the company, cutting into the bone?
That's the worry, isn't it?
Yeah, how can they possibly hit their guidance? They're guiding for what, 20% sequential growth in the second half? How do you achieve that with what sounds like a skeleton crew? Where's the engine for that growth?
That's the absolute key question. It's the friction point the market is latching onto. Management's argument, their defense, is technology. They claim they're offsetting those personnel cuts by really operationalizing AI, getting clear, measurable results from AI that drastically cut the cost per transaction, the cost to serve.
Right. It's one thing to cut costs and, stop the bleeding, but turning that into actual growth, how are they going to restart that engine? Let's talk catalysts. What did they actually point to that's supposed to deliver that 20% sequential growth and win back the market's trust?
Okay. Yeah, they got pretty specific on the AI front. Take customer support. They're automating, get this, 70 to 80% of incoming inquiries with AI.
70 to 80%. That's huge.
It is. And think about what that means. You get 24/7 coverage. You can handle big spikes in volume without hiring more people. It drives down the cost per case significantly.
Makes sense. What else on AI?
Competitive intelligence. They're automating how they track competitor offers, website changes, UX stuff. They claim it cuts manual research time by like 90%.
90%?
Yeah. And that feeds directly back into their pricing and reward decisions, making them faster and smarter. It's a direct link. AI investment leading to better unit economics.
Okay, so AI is handling efficiency, cost reduction. What about actually generating more business? Product innovation.
The focus there seems to be entirely on conversion rates, lifting the percentage of people who start an application and actually finish it.
Makes sense. Any examples?
Yeah, in insurance. Auto insurance is apparently scaling up. They mentioned real-time pricing in Hong Kong and Singapore. But the one they really highlighted was travel insurance.
Okay.
They've rolled out this simplified 3-click purchase flow.
3 clicks. Sounds good. Is it working?
Apparently, yes. They said it's already delivering over 40% end-to-end completion rates in Q2.
40% completion on travel insurance. That's actually incredible for this kind of product online. That is a real game changer if it holds.
It's a monumental number for the industry, absolutely. And then in wealth, they're looking at digital assets.
Oh, crypto.
Well, carefully. They talked about compliant collaborations, mentioned OSL in Hong Kong specifically, which is a regulated platform. The key phrase they used was programmatic, capital light, and regulatory first, meaning they use their platform to connect users to these regulated opportunities, but they aren't taking the balance sheet risk or the direct regulatory burden themselves. It's a marketplace approach.
Smart way to play it. Okay, so those are things happening now. What about looking forward? Any big new launches planned?
The main one is the Credit Hero Club. It's launching in Q4 in Hong Kong in partnership with TransUnion.
Credit Hero Club, what is it?
Sounds like a premium membership program. Offers users their credit scores, credit monitoring, personalized financial offers.
So moving beyond just one-off transactions, trying to build loyalty, get stickier relationships.
Exactly. The idea is to deepen engagement, drive more qualified, repeat applications, and turn casual users into members.
Okay. So you put all that together, the AI efficiencies, the conversion wins like the 3-click flow, the new membership club. Management thinks this is enough.
They seem confident. They're guiding for that sequential revenue growth of over 20% in the second half. They reiterated the goal of hitting positive Adjusted EBITDA later in 2025.
Right.
And they expect that insurance and wealth mix to climb even higher, maybe 28% to 30% by year end.
Okay, so if the internal story, the operational improvements, the forward guidance, if it's all that positive, why the 18% drop? Let's circle back to that disconnect.
It really comes down to market impatience, doesn't it? It's just a classic example of public markets punishing companies for doing the right things for the long term, if it means short-term pain or a miss versus expectations.
So investors just looked at the consensus estimates, saw the top line miss, the year-over-year decline, and hit sell without digging deeper.
Pretty much. They prioritize that immediate transaction velocity, the headline number, over the promise of future margin stability and profitability, even if that profitability is already starting to show.
And if we zoom out, look at the whole industry. Financial comparison sites, fintech. This pivot MNY is doing, focusing on higher margins, recurring revenue like insurance and wealth, using AI to slash customer acquisition costs. Isn't that what everyone is trying to do right now?
Absolutely.
Yeah.
Their strategy aligns perfectly with where the smart money says the industry needs to go. Tighter unit economics are essential for survival, let alone thriving. M&Y is actually doing it.
But the market seems to be saying, great, but it's taking too long, or we don't fully believe you can bridge that revenue gap quickly enough.
Exactly. Management is building, as they say, a leaner, higher quality revenue engine.
Yeah.
The reason for that 18% haircut is whether the cost cuts and the mix shift can plug that revenue hole fast enough to satisfy impatient investors. That 20% sequential growth target for H2, that's the number everyone will be watching. That dictates the narrative.
Yeah, does it stay a restructuring story or does it flip back to being a growth story? That H2 performance is key. Which inevitably brings us to, well, the fact that the stock is now trading like it's distressed. Down at what, $1.82 after the drop?
Yep, that's where it's settled.
Okay. Time for our disclaimer section. This is not financial advice. We are absolutely not recommending anyone do this, but purely as a thought experiment. If you were to construct a leveraged, maybe even slightly outrageous speculative play based on this massive divergence we're seeing, what's a thesis?
The thesis is pretty straightforward, actually. The market has hammered the stock because of the top-line risk. That risk is now arguably fully priced in at $1.82.
Okay.
What is not priced in, potentially, is the near certainty of that adjusted EBITDA inflection point happening in the second half of 2025. The margin improvements, the cost cuts, those are real. They're structural.
So you're saying the market punished the, revenue miss, but ignored the how? Structural repair?
Essentially, yes. You're potentially buying a structurally repaired, soon-to-be profitable business at a distressed price. The story shifts from growth disappointment to restructuring success.
Okay, if you buy that thesis, that an H2 inflection and a re-rating are coming, how do you play it, given the likely volatility in the low share price?
Well, given the volatility, options seem like the way to get leverage, right? So the outrageous but plausible trade could be something like a calendar spread using call options.
A calendar spread, explain that.
You're making a high conviction bet that the stock will re-rate significantly once that positive EBITDA is confirmed, likely sometime in early 2026 after the full year results perhaps. So you buy long-dated call options, maybe June 2026 expiry, with a strike price anticipating recovery, say around $3.
Buying long-term upside potential. Okay, but that costs money, and the stock could still chop around or even drop further near term.
Right. So to finance that long call position and to hedge against that near-term uncertainty, you simultaneously sell shorter-dated call options, maybe expiring in a few months and at a lower strike price, closer to the current price.
So you collect premium from selling the near-term calls, which helps pay for the long-term calls. It reduces your upfront cost and gives you some protection if the stock stagnates for a bit longer.
Exactly. You're keeping your eye on the main prize, that re-rating event driven by the Credit Hero Club launch succeeding in Q4 and the confirmed profitability in H2 numbers while managing the ride to get there.
And the core bet underpinning this whole option strategy is really that those impressive conversion numbers, like the 40% plus completion rate on the 3-click insurance flow.
Yeah.
That's not a one-off.
Precisely. You're betting that playbook is transferable.
Yeah.
That they can apply similar strategies to the Credit Hero Club, to other high-margin products, if they can compound those conversion wins across the board.
Then when the positive EBITDA number actually hits the P&L and gets confirmed, the market will have to acknowledge the improved structure and award a higher multiple, maybe pushing the stock well past that $3 strike by mid-2026.
That's the speculative bet, a leveraged play on the compounding effect of those structural conversion gains finally being recognized.
Okay, again, not advice, just a thought experiment. So let's recap this deep dive then. MoneyHero, MNY. Structurally, a much healthier company now. They actually reported positive net income, $0.2 million. Cost base is way leaner. There's a clear path mapped out to sustained profitability.
But the market reaction, pure impatience, focused entirely on the slower revenue recovery, the top-line miss.
So the whole bullish case really hangs on whether their AI tools and those operational wins like that 3-click flow can genuinely drive conversion rates high enough, fast enough to make that 20% sequential growth target believable and sustainable.
Yeah, can they basically grow their way out of the revenue hole they dug intentionally to fix the underlying business economics?
That's the tightrope they're walking. That trade-off between fixing the structure and satisfying the market's need for speed, that's what you, the listener, need to watch closely now.
Yeah, just think about that divergence. Internal reality versus external perception. Which one wins out? Management's methodical path or the market's demand for instant results? That's the drama playing out.
Indeed. Well, thank you for joining us for this deep dive into MoneyHero's Q2 earnings. Plenty to think about there. We'll catch you on the next call.